What is the market outlook for alternative investments, and where are some of the biggest growth opportunities? To find out, come join us in hearing from investment experts across the field, all the way from infrastructure to real estate, forestry, and beyond. In this episode, we will explore the investment opportunities and market outlook for private debt from Evli's portfolio manager Ville Toivakainen. Ville has over 20 years of experience from alternative investments and around 15 years from private debt. So great to have you here, Ville.
Thank you, Petra.
So thinking of private debt as an asset class, one may argue that in volatile, uncertain market conditions, private debt becomes an ever more attractive asset class. So what are the reasons behind this?
Yes, companies indeed face lots of challenges at the moment. So economies are slowing down, interest rates are going up, they have labor shortages, they have challenges in the supply chain, so all kind of challenges. So it's very difficult for them to maintain the profitability of the businesses. So in this kind of uncertain times, it's very good to be senior lender of these businesses, so being on top of the capital structure. That means that you have the first priority for all the cash flows to receive the coupon payments, all the principal back. So in that sense, private debt is a very safe place to be. At the same time, rates are going up, so most of the loans in private debt are floating rate, and that's of course very beneficial for the strategy. So private debt at this point in time, it's rather safe and it's very attractive yields.
Very good. And looking at private debt as a whole, it seems that in uncertain market conditions, lending options become more scarce. At this point in time, banks are more reluctant to provide lending, while the debt market pretty much freezes up. So is private debt a great alternative in this case?
It is indeed. So the banks hate uncertainty, the markets hate uncertainty. So that's why they are once again slowing down the lending businesses. And like you said, it's very difficult to issue any new loans in the high yield bond market or syndicated loan markets. But at the same time, the companies still have the financing needs. So they want to do acquisitions, they have refinancings, they have other investment needs. So they need a source of financing. And private debt is still a reliable partner for that. So they are providing financing not only in the good times, but also in the bad times. Of course, they are more selective as well at this point in time. So they are providing less capital and they require more return for the capital. But it's still providing the financing for the businesses.
Great insights, thank you. And looking at private debt as an asset class, it seems to be a very diverse one, given that the target companies can be very different. So what's your view on this, and what kind of companies does private debt suit for?
It's very diverse indeed. So it's broad range of companies in terms of the size. So it starts from very small companies, like companies with less than 10 million of EBITDA, into companies that have hundreds of millions of EBITDA. And it's very wide range in terms of the sectors that those companies focus. Mostly it's non-cyclical businesses like information technology, healthcare, business services, but also some other sectors as well. It's very diverse in terms of who owns these companies. Private equity sponsors are a big part of the private debt, but also family-owned businesses get financing from private debt. Even listed companies get financing from the private debt. And then it's very different kind of companies in terms of financing needs. So some companies need it for acquisitions, some companies need it for liquidity purposes, some companies need it for restructuring the whole balance sheet, so having long-term challenges. So it's very diverse set of companies who get financing from the private debt.
Yeah. And thinking of timing, when would you say is the best time to invest in private debt?
Market timing is very difficult even in the liquid markets. And I would say that in the private markets it's next to impossible. So instead of trying to time the market in a private debt, I would say that it's rather better solution to focus on building up all-weather kind of portfolios. So diversifying that through different strategies, through different geographies, and over time as well, so different vintages. And that brings nice long-term stable returns, what you should expect from asset class like private debt.
Makes sense. And switching gears a little bit and thinking of ESG in private debt. So what would you say are ways to gear companies towards more sustainable operations?
Of course, as a lender of the company, you're not able to control the business. So big part of the ESG is done before the financing have been provided for these companies. So in the loan documentation, it has to be noticed that, okay, how do you take ESG into account? And it started, of course, first with exclusion, so only provide financing for certain sectors or excluding some of the sectors. But now in recent years we have seen more and more engagement of the lenders, so that in the loan documentation there are certain KPIs that lender or borrower has to achieve to get some cheaper financing.
Yeah.
And these KPIs can be, let's say, carbon reduction or less water consumption or something like that. So it's taking that into account in the loan documentation.
Yeah. But from an investor's perspective, one may argue that attaining a lower interest margin would be less attractive. So how do you see this potential dilemma?
That's very true. So of course, it might be better that companies have to pay more if they don't achieve those goals. But at the same time, if the company really does right thing and does those improvements in the business, it's less risky on a long term.
Yeah.
And you could argue that on a long term, risk-adjusted basis, the return is still very attractive. And of course, these ratchets are rather small, so they're 5 basis points, 10 basis points, 20 basis points, something like that. So it's very small part of the total return the investors get from the loan. So from that point of view, it's rather good to have those ratchets. Yep. Of course, ultimately, in the end, it goes back to the owners of the businesses. So they have to believe that they do the right thing by implementing these improvements, and in that way, maximize the long-term value of their businesses.
Yeah. Thank you so much, Ville, for the valuable insights on private debt. We will be back soon, next time exploring the investment opportunities in private equity. So stay tuned. This is Evely.